there are many ways that you can accumulate physical gold and silver. That sterling silver jewelry or the Mexican silver 925 jewelry, that's 92.5% pure. 14 karat gold, I think it's 54% pure, 18 karat, 10 karat. Okay, there's gold in there and it's recoverable. So there are many different ways that you can accumulate gold. I mean, you used to be able to go, I used to do this all the time, go to estate sales, go to Goodwill, sure, go to yard sales, and people would have sterling there and it was all bent or broken or tarnished. And they go, oh, yeah, I don't want it. I'll take it. It doesn't matter. So even if you do have $50, there are ways to accumulate silver and gold. Aunt Bessie's sterling silver, candlesticks or salt and pepper shakers or flatware or any of that. Mm-hmm. And it doesn't have to be pristine. Silver as the secondary currency metal and gold as the primary currency metal is silver gets used up in manufacturing.
Okay.
Whereas gold is recoverable. So we can account for about 98% of all of the gold that has ever been mined. It's used in every single aspect of the global economy, which means that it has the most function of any asset and therefore the broadest base of buyer, right? Because sure, you have entities that want to buy it in every single sector of the global economy. It's really simple. The current monetary system, as it's been designed with inflation in it, every single currency that has only been backed by a government and a government's ability to create more debt has collapsed, and its purchasing power value has gone to a big fat zero, a big fat goose egg. Officially, according to the Federal Reserve, we have roughly 3 cents left in terms of purchasing power out of the original dollar. And that is by design. Inflation is not a monetary phenomenon. It is a fiat money phenomenon. And fiat, the literal translation is by decree. So this is a government-based money, and what backs our currency? The full faith and credit of the government, right? That's what backs all right, of the currencies that are out there. So if you translate that, as long as you trust them and you have faith,
yes,
then you will continue to loan them money, extend them credit. They knew, number one, that people marry the legal money of the state. So people can't but help but think it'll regain some of that value. And it never does. It never does. That value, that wealth transfers away from the normal person and to the elites. It's what enables that income and wealth inequality. Now, the key tool that central bankers have to regulate the rate and speed of the inflation are interest rates. And the system really died in 2008 when they dropped interest rates all the way to zero, and they've held them there until last year.
Right.
The attempt that they made in 2016 to raise the interest rates failed. It was a big fat fail into 2019, and this will be a big fat fail again. Everybody, Wall Street's waiting for the pivot. So they are having trouble getting off of that zero. It's called zero lower bound, so anchored somewhere near zero. And, the way that it regulates the rate and speed of inflation is, and you can look at the charts on this, but if we're in a recession, then they drop interest rates down, people borrow and spend, and that stimulates the economy. The only reason why Japan has survived this long, this is from the early 90s when their system collapsed, is because the rest of the world enabled them and allowed them to do it because they were a key part of the global economy. But their central bank owns their bonds, owns their stock market. I mean, it is just money printing that has really even give you a semblance of any level of normalcy. But you cannot build wealth on debt. Back in the early 70s, the average CEO's wage to the average workers, well, it was 20 to 1, okay? Today, in many cases, it's over 1,000 to 1. So definitely winners and losers are absolutely chosen. But what everybody really needs to understand is that wealth does not disappear. It merely shifts location. So if you're losing because your wages aren't keeping up with inflation, I'm pretty sure Jamie Dimon's not having any problem putting food on the table or buying anything else that he might want, right? The narrative is garbage. It's just about nudging you, and that's their word, not mine, to believe what they want you to believe so that you move forward in a manner that supports their goals. It's a con game. You know the real definition of price stability, because I always talk about price stability. Mm-hmm. Now, the normal person would think, well, that means that the prices don't change. That's price stability. But that's not the definition of a central bank price stability. Price stability for them is the level of inflation where the normal person does not change behavior. So they don't ask for a raise. They don't mind paying a little bit more for their goods and services because their perception is that the inflation is low. But now that the inflation is running hotter, and I don't believe that there's ever going to be a soft landing. I think that's garbage. It's inevitable. So yeah, I mean, we are at the end of the system, and the only thing that's holding it together is confidence. That's why you always see them check consumer confidence, inflation expectations, and all of this, because that's the other piece in their toolkit, central bank toolkit, and is that confidence piece. And for the markets, they gave that away last August when they used what's called forward guidance. So the central bank comes out and tells Wall Street, we're going to hold interest rates low for a long time, or we're going to do this, or we're going to do that, and gives the markets a chance, Wall Street players a chance to get into position to benefit from that. Okay, well, that was a key tool since 2008, the financial crisis in 2008. But in August, they kept telling everybody 50 basis points. They were going to just raise rates 50 basis points. Mm-hmm. And then all of a sudden they surprised the market and they rose 75 basis points. That may not seem like that big a deal to you, but what Wall Street learned in that moment in time is that they cannot any longer trust what the central bank is saying that they're going to do, because they just showed them they'll do something different.